Hey everyone, welcome back to Corporate Decoder, the place where we decipher what companies are really saying between the lines of all that official jargon. Today we're digging into a filing from ESG Inc, and by the end you might just be craving a plate of economic disclosures. Spoiler alert, we're talking about risks in China, mushroom powder, seasonings, and some complicated financial maneuvering. If you're into getting straight insights from corporate documents, make sure you're subscribed and join our Discord channel linked in the description below. Let's get started. This is a post-effective amendment from July to their registration statement. Basically, they're updating some details on their previously filed paperwork. The company ESG Inc. wants to sell 5 million shares of their common stock. They're planning to sell these stocks at $5 a share in this offering. ESG describes itself as operating its businesses through Chinese operating subsidiaries, and none of the officers and directors reside in China. This offering is set to wrap up around December the following year. ESG Inc. admits that they arbitrarily determined the proposed price, which might not reflect the true value of their securities. Think of it like setting the price of your old bike without looking at what similar bikes actually sell for, but they considered their capital structure, which at the end of the day, it's better than only having one gear. Now, here's where things get a bit spicier. The company acknowledges that a large portion of their operations is based in China, and that introduces risks for US investors, because ESG has operations based in areas where the rules can change quickly. Also, the Chinese government may intervene, adding risks. They mention the system of laws in China, in addition of risks of Chinese government intervention or influence in the company, or even control for offerings and foreign investment. This could limit their ability to offer securities or complete offerings. The Chinese rules and interventions can decline investors' investments and cause its securities to drop in value or altogether become worthless. So heads up. Now, who are these Chinese subsidiaries they keep mentioning? Fernald United Pharma Products, or AUFP. They engage in the research and development, composting, cultivation, processing, packaging, and distribution of high-quality white button mushrooms. They are trying to make Fuyong, China, the big hub to supply mushroom in Asia. AUFP owns land use rights and facilities around 300,000 square feet, supposedly enabling them to produce a fresh white button mushrooms capacity of 7,300 tons as well, 90,000 tons of phase 3I compost. You may ask, what is compost? More on that later. Here, let's break down the mushroom growing process itself. They start with putting mushroom compost into growing rooms, followed by a layer of peat. Then, after a 3-4 day period, the mushroom grows, after which there are levels of moisture, temperature, humidity, carbon dioxide, and air movement been carefully monitored. As a result, tiny mushroom heads pins begin to appear. Turning to market trends, there's a growing demand for vegan and plant-based options. Mushrooms are seen as a nutritious vegetarian delicacy, and the global plant-based food market is expected to hit almost $78 billion in a couple of years, and doubling by 2030. That's a lot of mushrooms on the table. Looking in their assets, they boast one invention patent along with several utility model patents, registered and awaiting confirmation. As substantially all those operations are currently conducted by our PRC subsidiaries in China, any change in regulations might affect the company. Regulations around mergers and acquisitions and cybersecurity are also critical. Basically, if their operations change, existing laws change, or they get denied certain permissions, business will be affected, and that could affect any future offerings as well. It's unclear when they'll need permission from the Chinese government to list or get quoted on US exchanges. If the company inadvertently concludes that approvals are not required when they're running a risk. Let's look now at their holdings. Ji Young is considered the beneficial owner of DCG China Limited and thus has majority voting control. He has a serious control over the company, holding over 70% of shares. As a result, our executive officers and directors may be able to elect or defeat the election of our directors, amend or prevent amendment to our certificates of incorporation or bylaws, affect or prevent a merger, sale of assets or other corporate transaction, and control the outcome of any other matter submitted to the shareholders for vote. Accordingly, our outside stockholders may be unable to influence management and exercise control over our business. This is a serious position to be in. Now let's get to the key aspects of this offering. They are offering 5 million already arbitrarily priced shares at $5. They will have around 31 million shares outstanding after the offering, and proceeds are for new programs in the States. Assuming they completely sell all shares, that's 25 million raised. If they only sell 25% of the offering, that's a bit over 6 million. ESG also hopes to use proceeds on developing new programs, working capital, and general corporate purposes. It's like they have an investment portfolio, but its growth depends a lot on consumers wanting more sustainable food. Looking at some of the risks, health epidemics and outbreaks, especially in China, could hurt their business. Disruptions and slowdown of facility operations would affect the economy as it did for them in 2021. It is also said that key clients lost revenues, revenue and profitability is also one of the many risks. They're also not very diverse. They focus on mushrooms and mushroom production, not much else. If mushroom popularity falters, they're in trouble of being unable to operate. So diversifying crops reduces cost per unit to reach a scale effect. They are also potentially vulnerable to the food industry by the Chinese government. New laws or stricter interpretations of existing regulations could cost company more resources to comply. The whole business is at risk and uncertainty if based in China today for the complex regulatory reasons. There are potential risks related to the laws, the relationship between China and the United States if there were changes. New regulations and interpretations for their business that might impact can result in more licenses costs, subject them to new cost. To add another risk, China could control over the foreign currency conversion to remit dividend, affecting their operations. There are no plans on distributing earnings. According to the material PRC company under PRC laws, there is no tax on issuing stocks as long each person doesn't pay any PRC taxes from citizen, residential, etc. Lastly, we see that Ji Yang, the company's CEO, had transferred shares of common stock to DCG China Limited, which in turn his mother owns. However, Mr. Yang may be able to elect or defeat the election of our directors, amend or prevent amendment to our certificates of incorporation or bylaws, and our outside stockholders may be unable to influence management and exercise control over our business. ESG can transfer cash between the company by dividend amounts between the parent and subsidies, but we know the company has no plans to distribute earnings or dividends. So what's the takeaway here? Despite some concerning risks, ESG has some potential. They're going into value-added products, and consumer plant diets are going to be in demand in the next several years. And by arbitrarily raising the value of each share to 5, you could argue that investors will experience a dilution of book value depending on funding level. It brings the final book value per share to 0.7 if we assume all the shares offered would to be sold, and on the opposite end, only 25% would bring the book value per share to 0.53. Accelerating Holding Foreign Companies Accountable Act helps the auditors be accountable and subject to trading inspections. But ESG said trading will not be affected by current auditors headquartered at United States. Looking at this all together, is this a mushrooming success or a fungi failure? Well, the operation scale is very small and there are great risks associated with operating in China. Not only that you have the same person on both ends with the transfer of common stock for a single person controlling over 70%, making it very difficult for others to influence any decision. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives, and definitely join our Discord to come to your own conclusion. Thanks for watching. See you next time.